I think it's undoubtedly there has been some blending of the industry, in that consultants have moved closer to asset management and asset management have moved closer to consultancy. I think without doubt, as a trustee, what they should be looking for is a service that suits them and fits them in terms of what they want to achieve. And I think that means one that is unconflicted, or as unconflicted as it possibly can be, and that also, and they understand the model and the way in which the consultant or the manager works to deliver that solution. So some of the things that I think should be clear, for example, are fees. They should be, totally transparent. So not, for example, not locked up in one overall fee, so you can't see what the fund managers earn and what the actual fiduciary provider earns, but a nice level of transparency there. And I think you also, if I was a trustee, I'd be wanting to appoint somebody who actually listened to what I was trying to achieve and took on board my investment beliefs and not just their own investment beliefs, because I think it's about being joined up in what you're trying to achieve and deliver, rather than just being told by your fiduciary, this is how you do it. You want them to actually listen to what you want to achieve and how best to implement that, because different trustees will have different aims. Some will look to be cost minimisers, some will look to be information maximisers, just to give you two extreme examples. So it's very much about having a good relationship and having that comfort and that level of trust and faith in the service that actually is being provided.
I think it's important that the trustees get the fiduciary manager that gives them the degree of control and flexibility that they're seeking. And they might need to be helped through what that actually is. But they also need the nuts and bolts underneath that to be high quality. So they need someone who has the trading expertise, the ability to select the right managers for the right job, the ability to help the trustees make good hedging decisions or have a good framework for hedging decisions. So they need, it's not just about having the manager that you like, can talk to you well and can explain things well. They still have to be good at the things that are actually the basics underneath it all, of which there are many. And it is an interesting question as to, can one house be good at everything? I mean, that's, I suppose, a question that's out there, because at the moment, if you do delegate a lot to a single house, even though they may be making choices of managers beneath that, you still are placing a lot of faith in one investment mindset or something like that. So that's a slight question mark out there, but I do think it's about getting the right partner for you, but make sure that the nuts and bolts underneath that relationship are of a high quality, and get some help in making those decisions. Yeah.
What do you think of the to what extent is this cross-dressing issue?
Yeah, that's an interesting. I mean, the consulting firms have taken on board an element of competence in the asset management area, but they're all doing it in a different way. Some of them are doing it by creating pooled funds. Some of them are doing it in a more hands-on way. But they're not true asset managers. I'll be shot down in flames for saying that. But they don't have the DNA of an asset manager that's been trading, that's got deep capital markets knowledge and expertise. They haven't been doing it for very long. Even if they've bought in expertise, they haven't been doing it for very long. I thought when this was all going to happen, I thought the asset management houses would clean up, because I thought they'd be able to go in, pick out the best people from the consulting firms, because they could afford to pay them, and move swiftly on and take a swathe through the consultants' client base. It hasn't happened, and I still don't really understand why. So there's been less cross-dressing, as you put it, than I would expect.
Yeah. Perhaps a way to look at this and to kind of make sense of consultants, asset managers, and, by the way, in-house teams like ourselves coming out and offering their solution to multiple pension funds. One way to look at it is the consultants have so one part of the solution has to be the funding objective and the liabilities, and the consultants have tended to be quite good at that, at understanding the liabilities. They often provide the actuarial service at the same time. The other side is the asset side, clearly asset managers have got the most in-depth experience in managing assets and realizing that there's tax issues when buying emerging market bonds in Brazil and all the little details that, frankly, most consultants wouldn't be as aware of. So they're each coming from these two different angles. The question is, in the fiduciary management solution, somehow you need to combine these two and bring them together. So you need an understanding of the liabilities and the funding situation. You need the in-depth experience and ability to act and implement the ultimate assets. How do you bring that together? And that's where I think the competition, I guess, is between those two parts. What we would, of course, say is that we've always been in that third bucket, bringing together both the in-house pension fund perspective, the understanding about what the ambition is of the trustees and what the different ways strategically are of getting there, and bringing together that internal expertise in executing the implementation of the assets. So I think that kind of paints the picture of where we find ourselves in the market. What I think are important, one thing that surprises me as I go through selection processes is that a fiduciary management appointment is sometimes treated just like another manager. It's a 1 hour, perhaps 2 consecutive 1 hour meetings, all PowerPoint presentations, no site visits. Yet one of the fundamental aspects in services that the fiduciary manager provides, as Queen has also said, is the execution. So you want to see some systems, you want to see some trading desks, you want to see actually on the ground, is this an organization that is built to be a fiduciary manager? Or is this just a bit of spreadsheet work and old legacy manager selection capabilities being relabeled, cross-dressed as a fiduciary management solution? So I'm surprised to see that there's not more site visits in the due diligence process of appointing a fiduciary manager. Because it is a strategic partnership. It's not just a product that you buy and then you get rid of it again 1 or 2 or 3 years down the line. Presumably this is a multi-year, longer-term strategic relationship that you want to spend some time up front. Perhaps the other, quickly, I'll add 2 more components. I think focus is really important. I think there's a number of organizations out there who provide investment consultancy and actuarial services, and oh yes, we also, and perhaps asset management services, and oh yes, we also provide fiduciary management services. How much of the organization's focus is on actually being the best fiduciary manager? How many internal fights need to be fought when a problem needs to be solved? And for management to say, I'm going to put the resources into the fiduciary management business because it needs it, rather than in the investment consultancy business. These are the softer parts of what drives an organization, but I think they're really important. And finally, experience. We've been doing this for more than a decade. I can tell you we didn't build our systems and our processes overnight. We weren't born with a fiduciary management toolkit in place. It takes time to learn those lessons, to improve, learn by doing. And clearly it is better to partner with an organization that is further down that learning curve than someone that has just started.
Malcolm, what's your perspective on these issues?
Yeah, so I suppose from a trustee point of view, you're asking the question as to what kind of things you should look at when choosing a fiduciary manager. And Remco's touched on some of them, and I think one of the ones particularly is this question of being well established, which sums up this fact of someone that's been in the market providing this kind of service for a time, has gone through the difficulties and the problems that arise with it, and has come out the other side with solutions and with methods and procedures that can cover these things. So from a trustee's point of view, it's a question of, first of all, I think, yes, having a partner that is really well established in the business, that you can see and transparent and understand their investment processes, that you understand how their front office, middle office, back office actually operate between them. What checks and balances are there in these different areas, so that as much as can be reasonably expected, you have got a controlled environment in which you're placing your money. Then there is the question of having transparency in what your managers are doing. Trustees should be able to understand what actually is happening in their name or with their investment. Then you go on to communications and reporting, which obviously should be of the highest standard. You've got to be able to feel that you can get in touch with your fiduciary manager when you want to, and at your timescale, not necessarily theirs. So one puts a lot of reliance on those kind of relationships that are built up between yourself, because you've got one major focal point. Therefore, it's got to be good. You can't have it as an also run. And I suppose that's really, the thing that trustees are in control in terms of they can see what the valuation is, they can see reports on an independent basis, not even actually going to the manager themselves, but are able to get their own information in an easy fashion. Quite.
I'm less concerned about the issue of the cross-dressing. Right? Naturally, it's about functionality and experience. So some of the what you might call legacy consultants who are now doing fiduciary management have more established asset management capabilities, but equally some of the asset managers have what you might call a more limited understanding of the nature of the investment problem or engagement with trustee issues. And so the challenge for trustees when trying to select a fiduciary manager is trying to find someone who's able to cover enough of the bases and is able to prove their experience and their capabilities in that area. So it's not just a matter of do you have an asset management function or do you have an advisory function, but is your business aligned with the development of fiduciary management, with the interest of the trustees? Do you have conviction in the way you go about investing your assets? So if trustees come to you and say, look, we really have no idea what we want to do and we're really looking for help, can you say up front, this is our preferred way of investing your money, this is the way that we would like you to do it? And when they say, we're uncomfortable with certain aspects of that or don't want to take the full step now, is your fiduciary manager flexible enough, accommodative enough to be able to incorporate that? Those are some of the issues, in addition to some of the topics raised earlier, that I think help define the framework in which trustees should be thinking when selecting a fiduciary manager.